evening, ladies and gentlemen. I'm Sankalpo, and as you know, I take care of business development at PMS AIF World. We are one of India's leading digital online wealth management services. We've been doing a lot of interesting things of late, and in continuation of that is today's webinar. We have a very unique topic, very special topic, something that we are discussing for the first time. It's the market is at 18,000. What ahead for next Diwali? What ahead for next Samvat? And we have a very special guest, Mr. Anil Rego, representing Right Horizons, to discuss on the topic. Before that, let me just put to you all of our previous sessions are available on YouTube, and if you're watching this on YouTube, please do subscribe and like this video so that more people can reach this. So coming back to the topic and coming back to the speaker, Mr. Anil Rego has seen Nifty from its lower thousand levels to Nifty becoming a double-digit thousands figure, then to a teen, and from there now an adult finally. So Anil, it's been a journey, and Anil has done a lot of good work in over these years, and today his experience will tell us what he thinks of where the markets are, where economy is, where businesses are, corporate earnings are, and what to expect ahead after the stellar bull run. So just a little bit of introduction about Anil. He's the managing director and CIO at Right Horizons. He manages multiple strategies at Right Horizons like FlexiCap, India Business Leader, Super Value, amongst others. He's an MBA and CFA degree holder. He's a seasoned investor of over 2 decades of experience, and his last and only job was with Wipro Technologies. In the corporate world was with Wipro. He was involved in business planning, corporate finance, and mergers and acquisitions. He's often featured as a leading voice on various media channels, print or otherwise. He features as a guest lecturer at a lot of leading management institutes, and has co-authored a very interesting book titled Honey, I Lost All Our Money. So welcome, Anil, to the show. Welcome to the audience. Anil, I think your light is switched off.
Yeah, so I guess we had a disruption here, so maybe we will, the generator will just come on. So excuse for that.
Sure. So, what times, interesting times we live in, and technology is so powerful that it still helps us connect with you. So, Anil, what do you want to do? Do you want me to begin with the presentation or wait a couple of minutes for the part to come back?
Yeah, so maybe we can, put it on. I think it should come in any time now.
Right. I'll just start the presentation. So, Anil, the poll that we asked, how do you expect market to do over the next 1 year? 60% expects, 63% expects the rally to continue, and with that we have the power back. So that's signaling that we're seeing. So Anil, why don't you introduce Right Horizon in that while the presentation is being uploaded?
Sure. I think shall we wait for the poll?
The poll results are on with me. So 60% expects the rally to continue.
Okay.
35% expects a range bound kind of a market, and 9% expect a market correction.
Okay, so it's good that we have a lot of people who are positive on the market still. Okay, because at times I've been finding a number of people come back and say, what, I think market is going to fall really bad. Okay, so is it the right time to invest? I always say that when markets are trending and moving, right, everybody becomes a fund manager. Okay, and they have a view. I think we'll go through the session and maybe share thoughts at the end. Okay. Now, just to give a very, very quick brief about Right Horizons and our group. basically we are a niche wealth management organization, and we sort of manage over 1,500 crores, out of which a third of it is in the PMS side, right? So that's something which uh, we have built up over the last 18 years, and so we continue to like to be niche and deliver value to our clients. Our motto is to help clients achieve their financial goals. Okay, and broadly that's what we work towards. Now, coming back to our PMS, we have a whole range of products there, because I also like to have it pretty diversified. So we have multiple strategies, we have multiple fund managers, we have almost like 10 strategies, right from a small cap at the highest level of risk to even a balanced fund. And within the balanced fund, we also have three options which are conservative to aggressive. So we like to have a diversification for our clients. Sankalp, maybe if you can have the PPT on.
Right. So the PPT is on. Over to you, Anil.
Yeah. Yeah. So can we? So the theme today is about Nifty at 18K. I think the way markets have been moving, at every 1,000 points, you think, yeah, it's a new milestone, and it goes to the next 1,000. I think people, right from the market crossing the 14,000 of the Nifty, okay, it has been looking and moving forward very aggressively. So with this, keeping this in mind, what is the investment theme for the next Samvat? Okay, and one question that somebody asked me, okay, what is Samvat? Okay, so just to give you a brief on that, okay, Samvat is basically year in Sanskrit. Okay, so it starts with the next day of Diwali. Okay, so that's sort of a new year in the Hindu calendar. Okay, so in this new year, starting Diwali, what is it that we expect for the next 12 months? Okay, that's something that we will sort of capture, as well as get a little bit into the detail of at a stock level, and also at a sector level. Okay, more than a stock level, at a sector level, what we can do. With stocks, I like to avoid talking about stocks. Um, you know, but definitely on sectors we can sort of discuss about that. Yeah. So the point is, where are we? If you want to look at where we are in this the market, I think one would like to step back and say, let's understand where we are on the economic cycle, and I would like to go through this with you, so that you yourself maybe see where we are in the cycle, and you are better placed, because whatever is reflected in stock values, I think are a broad reflection of how the economy is doing. And we may find at certain points that it runs ahead or it runs slower than the economic cycle. Okay, but broadly you will find that the market is always right, and the economic cycle and markets converge over the longer term. Okay, so if I get back to the economic cycle, so what is it? There are four stages of the cycle. Okay, so if we start off with the beginning of the cycle, you find that it is beginning to rise. You find what are the various factors that you look at. The GDP growth starts picking pace from a period which is a lull. Okay, you start seeing return of inflation. Inflation, while you're in recession, etc., is very poor. Okay, and there's no buying power of people, so you find inflation has gone down. Okay, and slowly you start seeing inflation start coming up. The corporate capex also begins in full swing. Okay, slowly it starts picking up during this rising period. Interest rates, then as inflation rises, interest rates also begin to rise. The housing activity picks up. Okay, people start buying houses, they start getting comfortable, and also corporates are borrowing. There's credit offtake. In fact, both by corporates as well as individuals, and you will also start seeing profit expansion during this period. Okay, and then you get into a period which is a maturing period, wherein you slowly start seeing the GDP start slowing down. You'll find inflation, above the trend. You'll find inflation. It is very high. The rates are also very high, interest rates. You find credit slowly starts tightening. You'll start feeling the pinch there when credit. Too many people, trying to borrow, etc. So credit also will start tightening. Okay, profits start slumping slowly. Okay, credit offtake slows. Okay, so this is a period where it's slowly beginning to mature. That whole rise is over, and you find a maturing period, and at that point of time, you'll even probably see that your markets are doing pretty well. Okay, markets continue to be racing, expecting that things will continue to do well. Okay, in this period, you'll also find volatility in markets. Unlike the rising one, where you may see a runaway move, while you see a maturing market, you'll also find a lot more corrections during this period. Then you move over, once then you have the whole bubble burst, you start getting into the declining market. You have a full-blown recession. At that point of time, the economy shrinks. You have a credit. Nobody's borrowing money. They're not seeing visibility. Profit starts contracting. Okay, from this period, it starts contracting further and further. Okay, the confidence is weak. Interest rate falls. In fact, in this period, also find weak commodity and property prices, and this is a period when you'll find that government starts coming in, okay, and taking actions, and maybe we have a recent example, right? When the government comes in, when all hell breaks loose, you found that there's several times we found the government come in, as the COVID fall happened. So that is broadly what you see, in a recessionary declining sort of market. The capex also completely dries up, and you may see that in numbers as well. Okay, and then from there starts a slowly, the stimulus continues, by the governments. Okay, and that sort of slowly starts bearing fruit. Okay, slowly corporate capex starts picking up. The credit, again, at this period, it slowly and starts expanding, and you find that interest rates are beginning to bottom out, property prices bottom out, and you see the profits also beginning to break. So slowly started bottoming out and probably start sort of moving further from there. So that is something which you may sort of see out there. Okay, and now coming back to, we look at a few factors, and I think the point is we look at these factors and say, where are we? Okay, so, and I think some of you can help me on it on the chat, and we can have it a little bit interactive here, so that and then we'll probably conclude as to where we think we are in this whole economic cycle, and from there that may give us a good reflection of where we think markets can go. Okay. Yeah. So if you see broadly, one factor is interest rates. Okay, and one of it was that interest rates actually start falling. It has fallen. If you see from 2013 October, from 9.23, it fell all the way to February 17 to 6.18. There was an increase, and again, it fell off. So you found that interest rates now slowly, you can see that it is slowly bottoming out, and it looks like it's about to move up. So if I look at in this cycle, right? If I look at the clock, okay, where do we think at which hour do we think that it will be in the cycle? Maybe we'll run through one so that we get comfort here, and then I will look for input from all of us. Okay, so interest rates, we believe, are here right at if I can say 6 of the clock, and because it's sort of bottoming out. It's completed that bottoming out probably, and it looks like it's going to rise. So this is where our assessment of, where we think interest rates are. Okay, and so we are probably at a good place, between bottoming out and rising is what the thought is. Okay, now the next one I will take help from all of you. Okay, so if you can come back and share on the chat, where you think it is at, as the clock, right? So corporate credit.
So Anil, we ran a poll. Let me just say, I'll tell this to you. Where are we in the economic cycle? So the
Yeah,
options were recovery, recessionary, inflationary, and stagnation.
yeah.
Okay. So 72% of the audience feels we are in a recovery stage.
Okay,
So
wonderful. Okay, so that's wonderful. Okay, and so thank you, Sankalp, for actually bringing it up very quickly. Okay, and this spur of the moment. So it's wonderful. Okay, so if you look at the credit cycle as well, since you've given the poll, then let me run through this. Okay, you see credit has been falling, which means companies are borrowing lesser. We are right, at the bottom of companies sort of wanting to borrow. Okay, and so that is very, very poor credit of take. Okay, so we believe that we are probably in the bottoming cycle itself on credit. Okay, so that's another factor that we look at when you look at the economic cycle. Corporate earnings, and I think from here, so if you look at the chart as well, corporate earnings actually has started picking up, right? So, and already if you see quarterly results, etc., you would find that in the current year there is reasonably strong profit growth, and we think that will also sustain for a period of time, and that's a broad consensus that market has. And the second part is just I think coming back to cycles, right? If you look back, the second half of the chart, right, has periods where 97 to 2003 we saw only a 3.5% CAGR in profits. Okay, it was followed by a period of 2003 to 2008 where you have 25% CAGR in this whole period. Okay, and 2009 to 2020 again sort of came back to a 6% CAGR. Okay, so we went back to us, and I think hopefully this expectation that it will last for a period of like it's lasted 5 years in the previous cycle. It's not just, let's say, a 1 or 2 year type of period out there. Okay, and so we think corporate earnings, like I said, are sort of already in the rising side. So if I look at in the economic cycle, we are probably midway through the rising part of it. And if I look at the corporate capex again, now it looks like more like bottoming out. Okay, and where do we think we are? The capex again we think is towards the bottoming out. We are not yet seen signs of uptick. Okay, and normally you'll probably find that come in a little later. Okay, and the last is housing, right? Housing is the other thing that we spoke of, and it's interesting, like even through some of the difficulty post COVID, you're finding that the unsold inventory is at its 24-month low. Okay, and that's another indicator for us to say actually the economy is beginning to move up, and housing is is already started off in the rising phase. So keeping this in mind, I think broadly it's in line with our polls. Okay, and one thought that we'll get into the more theory of it, because if the economy is beginning to move and it's in the upswing, then you'll start finding that it sort of continues to do well. And this is a slightly longer term view. Okay, and that is the good news. So if you look at the economic cycle, it's not just a 1 month, 3 month cycle. Okay, it's a longer cycle, and if we are seeing what we are seeing, okay, then hopefully it should last for a longer period of time. Now, a lot of people came back in the past maybe 12 months, and as a fund house we went aggressive. Somewhere it was in our projections that we thought the economic cycle is going to turn around and come up. Okay, so we went a little aggressive on the COVID fall. We did go back and go a little more aggressive and get fully invested So those so that is something that if you're able to look at cycles and understand them, I think for you as investors, it's going to help you quite a bit. So this is what helps us make some of those decisions and move and people came back saying, okay, the market has just moved up. Why is it moving up? Why is it so high? And my view always has been that the market is a leading indicator, right? You'll first see the market go up, and then you'll know why it moved up. So sometimes, at the same time, we have to put various things together, like, do we think the cycle is bottoming out, etc., to be able to make a call as to whether it is a more sustained, bottoming out and an upturn in the economic cycle. Okay, so what do we think are the drivers which are going to drive some of this? We think you have demographic dividend, okay, which is basically we have a median age which is very low in India of 28, and the US saw a baby boomers period where almost like 10-15 years of sustained growth, okay, in their economy, and that really had a very long boom in their stock market. So one is hoping that we should also see the baby boomers period and the benefits of it. Low interest rates, I think all of us know, we've seen it. Okay, we are back to 2003 levels. Okay, and it'll be interesting to see whether 2003 cycle plays out again. Okay, and you also have growth drivers in manufacturing, China Plus One, Make in India. Okay, so I think some of these themes are reasonably well known, so I'm not going to spend too much of time on it. Okay, and I think the other important contributor is going to be actually the startups, and I think we all have got the confidence in ourselves to say, okay, let us not just make global, companies and be part of them and work for them, but let us also end up creating some organization of scale, and so that's what we are sort of going and doing. And there's a lot of confidence coming in. You find that the Zomatos of this world, the way they have got the valuations, etc., and the whole number of them lined up. I think startups, and the expectation even from some of the economists is that it'll probably add 1.25% to the GDP growth. Okay, so I think this is going to be a reasonably big theme, and it'll sort of also spur the economy. Now, coming back to if we drill down to how we look at it, so while you are managing stocks and your portfolios, etc., okay, and for you to understand how we manage our portfolios and how we look at risk-adjusted return, okay, I will come back to our philosophy itself, of a fund management fund house, and our philosophy is to actually deliver superior risk-adjusted return. Okay, and one of my key focuses is to see how we can actually live our philosophy, and if we do that, I think everything else will follow. And while we look for delivering risk-adjusted return, we also look at important risk management in place, because what if things don't go your way? So risk management processes that we have put in, okay, and also to look at a structured investing process. Okay, so our whole investing journey is broken up into 4 processes. We've already covered that in the past. Okay, so maybe you can go back and look at some of the old webinars of ours. Okay, and we actually have broken up the whole investing journey into 4 parts. Right from screening of stocks to booking profits, and which we call as pendulum. So each of these processes are something that we look at, and we use quantitative as well as fundamental frameworks. Okay, and most of our decisions I look at which is number based, which is some basis to it, not just gut feel. Okay, for us to be able to. So when we look at, for example, economic cycles, we look for data, and that sort of gives us more clarity as to how we think things are moving, and that has helped us deliver good returns across categories and across time periods. Okay, so this is some of the news coverage that we've had. Okay, so we have our large cap, which is Right Horizons India Business Leaders, or IBL that we call it. Okay, which has got a coverage from AIF PMS.com. We've got coverage from the Economic Times on our small cap. Okay, Minerva India Underserved. And we also have couple of other strategies, which is, both our flexi cap and super value. So, across categories, we have been able to make it. Okay. And even, some bit of coverage around economic times when I did speak about a contrarian call of IRCTC, because that's also part of the way that we manage things. So we took contrarian calls on IRCTC post COVID, and that sort of helped us look at it. And so when so like the particular article says, we bought in when it fell, and I think history shows where IRCTC moved. Okay, so and we'll capture it also in a slide. So how do we manage risk? Okay, because that's one of the fundamental things of what we do, and there are actions, again looking at economic cycles, etc., based on data. Okay, we reduced risk on our PMS schemes in October to December of 2019. Okay, and what did we do? We reduced the exposure to financials. It was reasonably high in the index, and we felt that financials will sort of they look like a little overvalued. We added pharma as a defensive. Okay, and when we looked at the markets, it looked a little higher on the valuation side. Interestingly, I think we didn't predict, say, it would happen because of COVID, but the fall happened because of COVID. Okay, and even during a communication to clients, we said, we expect Nifty to be see another volatile year. Okay, and it came in large measure with COVID. In fact, on the fall, like I mentioned before, we went and fully deployed our portfolio into equity. Okay, we took a longer tail, which means a more number of stocks, because we were not sure where the upswing will come from, and we wanted to play a little more safer and have that. So we had a lower exposure to some of the mid cap stocks, but we introduced them, and then slowly we started increasing the aggressive parts of the portfolio. We reduced the weightage in defensive, like pharma. We booked profits, and that was good because subsequently pharma didn't move up too much, and we added recovery themes. In fact, we even added metals in that period. Okay, so that was a bit of a contrarian call again. Okay, and we got it early in the cycle, and may not be exactly at the beginning, but where we found a little bit of confidence, we went and invested in metals as well, and continue to be positive. And again in September, October, which is the last in the current month, we found that stocks were just flying around, and some of our portfolio stocks actually had become gone ahead of the valuations in our view, and we thought we should see some bit of corrections. So a couple of highly valued stocks we sort of let go, and that was again timely. In fact, one of them we almost got it at the perfect timing. Okay, and the stock fell 25% from there. Okay, so that's something that we did, and we so reinvested in this recent correction that we saw. Now it may be a little bit confusing for some of us investors, because I'll give you an example of somebody who came to us and talking to us right through this period, right? The person wanted to invest in our PMS. Okay, was a little bit convinced, almost started, and then by the time on his own portfolio, he saw large corrections in some of these stocks, right? Especially the mid caps, and got a little nervous. Then he came back and said, should we do a balanced fund instead of an aggressive fund? Okay, and because he felt very unnerved, and time told that some of it got recovered over the last few days, and you'll probably see it happen again. Okay, so the thing is, what is it that one does as an investor, right? And what is it that maybe the learning that we can look at is, probably stay away from a lot of what friends, family, like at this time, many people will come and say, okay, why don't you buy this stock? Okay, I had another example where a person who had never invested in stocks, okay, came back and told me, somebody is telling me you should buy IRCTC, it will give you a fantastic return in 1 year. Okay, I told him, we've just sold it. Okay, and so the point is that we need to not get swayed by emotions, because at a time like this, if you are investing, don't get swayed by emotions. Be a little disciplined, and I think automatically you will find that things get corrected. So what we like to do is we look at data, and where we find valuations higher, and as per our process, like I said, we have a pendulum process which we look at buy and sell levels. and we also dynamically move it to a point where we say, yeah, is it also looking like, based on sentiment, things will also move down. Okay, so that's an important maybe learning that we can take home. And so if we look at, I just covered three schemes, because we cannot cover all of it. There's too much of, we have 10 schemes and going through it will take a lot of time. But if we look at both on a return basis as well as, on risk measures, we have done reasonably well. Okay, so I just captured a large cap fund, which is India Business Leaders. We captured a flexi cap fund. It's called RH Flexi Cap itself. Or it's within the multi cap category, as well as we have a mid cap fund which is super value. So three of these, one is captured there. And what is interesting to note, if you see in FY20, right, when markets fell, we fell much lesser. So IBL, for example, fell 24% versus 26% of the Nifty. Similarly, FlexiCap, RH FlexiCap fell 21% versus 27.6% of the NSE 500. And you must keep in mind, in this period, actually many funds underperformed and fell worse than the index, because not too many funds saw the sudden turn coming in, and they were trying to deliver higher returns, and they got caught in the wrong foot. So that is something that we have looked at proactively. And in 21, our objective was to, in a very strong year, how do we be in line with the index? One is happy that, we are also able to surpass it. And thanks to the fact that we went and put back money, at the market lows. And current year as well, with things settling down, I think we were able to again pull back with, higher alpha during the financial year. So which is why, some bit of the coverage that has come in. And the beauty of it all is, if you see all the risk measures, I think most of them you'll find that, whether it's a standard deviation, okay, whether it's the beta, okay, whether it is, and you look at the positive risk-adjusted return ratios as well, have done, better than the index. Okay, so that is something that one has been happy about, and we will continue to do that. What is the second aspect apart from managing risk? Okay, the second aspect which has helped us deliver returns, and this is also something that you can carry home if you are investing in stocks, okay, is to look at stocks and can we discover stocks early. Okay, so our whole effort has been to look at stocks early, and I'm just giving, these are webinars that we've done, so which the team does on Alpha Stories, capturing an example of one stock and running our how we do it with our investing process. We looked at Dixon, which is a leading electronic manufacturer, outsourcing company. Okay, they manufacture a lot of the mobile phones right now. Even they've got contracts for laptops and a lot of the electronic goods. Okay, so that is something that Dixon, and we saw this early. Somewhere we saw that the tiff between trade war between the US and China, and we felt that slowly there is going to be a push towards outsourcing and having China plus one was slowly emerging. So we went and bought it very early in that period of time. Okay, and that did extremely well. Okay, and similarly APL Apollo, okay, pipes. It's an emerging PVC pipe business. Polycab is another one, and if you see all of them in a short period of time, yes, some of them may have come down a little bit in this market fall, but I think those are we don't look at stocks in such a short period of time. I must, from a compliance standpoint, say that it's not a recommendation to buy any of these, and as RH, if we capture some of these as it's only illustrative, and we may also exit stocks, and not only this but any other stocks that we've covered in the presentation. And drilling down further from into managing the risk of our portfolio stocks and also looking for alpha. I think both sides should, not just managing risk. Okay, so we have a just to give you a flavor of how we go about it. Okay, and this is something maybe that you can also look at while you're in your investing journey. It's good to be with a leader. Okay, but it's actually great to be with emerging leaders. So we like to search for emerging leaders, and that is something. Astral was the leader, and you found that APL Apollo pipes actually did far better. So similarly, if we went to discovered versus undiscovered stocks, right? So Asian Paints versus Silica Paints, you can see that the huge difference that comes in, and similarly Havels versus Polycab. So the point that one is making is that where you find stocks which are undiscovered and they get discovered by the market, that's the best place to be, especially in the current period. The other one is about, we look for emerging themes, and I already spoke about Dixon and contract manufacturing, and we believe that China Plus One is definitely going to be there. There was the Make in India campaign of the government, etc. So and falling interest rates, which capital intensive industries would sort of benefit from it, right? With falling interest rates, we felt it was manufacturing was poised to do well, and especially contract manufacturing. So we look for themes, we look for specialty, and you go and maybe discover some of these, and we look at long term. Okay, you have to be watchful of valuation, and this is another point that maybe you can take home. Okay, in a bull market, you may find that there are periods when some companies just run ahead. Okay, and while we look at long term, if we find that from multiple parameters, including valuations, which we do based on a fundamental analysis, we also look at technical analysis, and on that basis, IRCTC, for example, was a classic case, okay, where we expected it, a 16,000 market cap crore company to hit, let's say, 1 lakh crores by the calendar year to 24. But in October 21 itself, it had 1 lakh crores, right? Yeah, the profits did very well, but the P ratio is a staggering number. So that is something that we felt a little uncomfortable with, and we took some money off the table, significant actually, and you can see how the stock price moved right from 1,600 to 6,000 in a very, very short period of time, right? And see the steepness of the fall as well. So the point is, if you're disciplined in your investing journey, if you go by numbers, and yeah, it's possible that you may end up getting out early. Okay, maybe this time for this particular strip, we got the timing perfectly right. In fact, I was telling another client that the person I spoke to about IRCTC, subsequently he said, "Oh wow, Anil, you did a great job." I said, "You know what? We were also lucky." Okay, so sometimes luck plays its role, and if you actually use financial numbers and basis to it, probably you'll be lucky more number of times, and that's what we sort of hope for, because it's impossible to get the exact turning points. So that's something that you should sort of okay. I'm not able to see the presentation. Sankalpo, are you able to see the?
Visible to me. I can see the presentation here.
Okay.
Is this visible to you?
It is not.
Okay, no problem. Just
now it's back. Now it's back. Yeah. So the previous one. So this. The slide after IRCTC, I'm not able to see. Are you able to see? I'll just go back.
Just 1 second. Just 1 second. Let me just. Yeah. This chart?
The next one. Next. Yeah, we can see it now. Thank you.
Perfect.
So, concluding and coming back to the themes for the next Samvat, okay, for the next year starting Diwali, okay, what is it that we expect? Okay, we think that there will be a continued economic recovery and the growth cycle will come in. Typically, it lasts between 3 to 5 years. Okay, so that is something that's a good news. It's not just a short-term one. Okay, however, okay, we think that there will be more volatility. And if you go back and again say, what if 2003 repeats, right? If you looked at back at that period, the Nifty started from 1000 of the Nifty, in 2003. It actually went to 2000 in maybe a year or two, okay, and then it fell all the way to 1500. So it meant it gave up about half of the returns, okay. But if you looked at it in 2008, it went up to 6000, okay, which means the index went up 6 times. Now one hopes that we see such a stellar move, okay, but I would rather be a little more conservative than that. But the point is, if we are actually in this recovery and we see the economic cycle playing out the way that we are expecting it to be, okay, then we can see much larger movements. And it's good to be disciplined at this time, okay. If you're able to stagger your investments, buy on dips, etc., it may be a good way of going about it. So in fact, one of the things that we do on our portfolios when clients give us money, especially on PMS, because they give us lump sum money, okay, is we actually stagger the investments, okay. So again, we look at some of the minor cycles, and if we're able to find some market fall, we go and then just push money in, okay. So we track things, pretty closely on a shorter period as well, and so we try to look at the client's money just as our own money, and see how we can actually get squeeze out every penny from the markets, okay. So that is something that we do, so we try to smoothen it out. Now the good part is we are a smaller organization. We also built our systems that way. So I have a tracker of all the deployments which are there, and my team comes back and says, okay, how much? I'll tell them, okay, this day let us do an X%. So that is something that we also do. Of course, we also have a systematic transfer basis, which most other funds have, okay. But apart from that, we also look at it in a staggered way in a shorter time frame, especially while entry, because we understand that if you get the entry period wrong, right, then it takes a long time to sort of recover. And I'm just giving us example of, let's say, a stock like IRCTC, right? If you're in the market like that, if it has run up ahead, I mean, and it falls, then it may take a long time for you to sort of recover it. Even though it may be in a positive side, but it may take a long time to recover it. And just because you enter in the wrong minor period, you may do a bad return there. But I mean, if timing is not your strength, okay, please be disciplined, and considering the view that markets are likely to play out in the economic cycle, it's a longer term. So you should be looking at deploying, and deploying slightly more aggressively than normal, because this is a period to participate, and subsequently maybe take off money when you have made great returns. Okay, and like I said again, it's important to manage risk, because at the next cycle, wherever the cycle turns, okay, at turning cycles of the market, okay, you will find that you see almost like a 40% plus market fall. And if you thought 25% was bad, okay, and one has seen at least 2 of those cycles which had more than 40% during my investing career, as well as while one was with Right Horizons, okay, and during my journey as an entrepreneur. So that is something that we sort of like to emphasize, that risk management is an important part, and one needs to do that. And of course, what are the sectors that we have looked at and we are continuing to be bullish on? Contract manufacturing across multiple segments, and there are segments as well, which maybe in the food side, it may be it can be as diverse. It could be on specialty chemicals, it could be on pharma. Okay, we saw even the electronic side. So I think manufacturing as a whole, and within that contract manufacturing, I think will do well. Okay, we continue to be positive on specialty chemicals. Logistics, I think, will start improving and start emerging much stronger. It has been a lagger for a long period of time. Technology, including emerging areas. So I think the standard names that we know, okay, may not do as much, because I think the smaller companies may be more nimble and be able to do well. So you also need to be looking for the new age technology companies. And today you have a lot of companies, I think, which are going to come for IPO, which used to be the startups of the world, okay, and significantly, while they're businesses, they're significantly based on a technology platform. Okay, so that's something that we think will do well. Okay, auto with a focus on EV, so electric vehicles, and financials. Again, financials, I think the nature also may change. The laggards may make a comeback. You may even start seeing some of the PSU banks. You may see new players. In fact, you have, if even the lending side, I think is going to see a huge transformation with technology playing a very, very important role there. While we go on the positive side, yes, it's important to always look at the negative side or the potential risks that are there. I think foreign flows and if the US Fed hikes rates, I also see that the US markets are have done very well. So if you see a turning point, I've not put that as a risk yet because I think it's a little further away. So that's something that will also be a slightly medium to long term risk. Okay, and commodity inflation, as it goes up in the initial period, it is fine. Okay, but over a period of time, I think inflation will start eating margins of companies. Okay, state elections are there, and politics always is not the best for economics. Okay, and global volatility in high debt. So there are, I think, more than India factors. One is concerned about the global factors. You have China and sudden regulation of its domestic economy, which is pretty surprising. Okay, and of course India is a beneficiary from that. Okay, so at least I'm not complaining. Okay, but definitely if it snowballs into something larger, then you have an issue. Okay, and the recent supply chain worries emerging out of some sectors like the semiconductor side, etc., having a shortage. Okay, and lastly, I think how can we forget COVID? Suddenly we are all very comfortable, but I think from looking at data and cycles, I think we should see a third wave. Okay, hopefully it should be not as lethal as the second wave. Okay, but that's something that we need to also look at and hopefully we'll have a lesser market than even the second wave. So I think that's about what I had from my side. So I wanted to take questions from all of you, and
Right.
doors open.
So that was very detailed, Anil. Thank you for the presentation. We have quite a lot of questions, from audience coming in, which is usually a very, very good thing. Thank you for the audience for being so participative and asking us questions. So before we move on to the audience question, I just have one question of my own. The investors are today confused as the market has run up quite a bit, and this is often a question that we get from investors. Ki abhi kya karna chahiye? Markets at 18,000, sometimes floating with 18,600, 700. So we cannot deny being in a bull run. So when you have understood market cycles, like you've said, you've successfully gone in and out of stocks, and you've seen also many cycles, and every cycle has made you a little bit wiser. So what are you doing? What are you looking at? I know you gave a broad kind of answer to this question in your presentation, but can we talk about valuations? What kind of sectors are you looking at? Let's not go at stocks. Where do you find the pocket of valuation, and what are you looking to buy or sell in the coming days?
Yes, Sankalp, actually, it reminds me of just in the morning, right? We have a lot of people interested in conversation. So while I was doing a walk in my layout, okay, this elderly person came back and told me, you know what, the last time I invested 12 lakh of rupees in stocks, okay, and it went up 20%, so I booked profits. And he said, you know what, it would have been today. It would have been 60 times. Okay. So I'm just saying a lay investor, elderly person, okay, having gone through all of that, okay. So my point is, if you need to get the big cycle right, okay, and if you get the big cycle right, I think there is much more there than trying to time too much. Maybe if you have the ability to track markets more closely, look at technicals and various other factors more closely, then yes, if you are a evolved investor, then you can look at it. But I think I would still be on the investing journey, especially and one has been pretty much coming back, right from 2019. It has been our view that we think that this decade is going to be the decade of India, okay,
Right.
and India will be the star. So I think that so I will put money into stocks, okay, but be careful, staggered, okay. Sectors I've spoken about a number of them, and I'm sure many queries also will come in, so maybe we can answer them, okay. But so with a positive bias, I think be a little cautious and use opportunities of falls. Okay, this is a period to use opportunities of falls.
Right. Thank you, Anil. So we have a very interesting question from Mr. Shubhankar Chakraborty. He asks, what according to you should be the ideal parameter to look while identifying emerging leaders? I think he's referring to your, discussion on Dixon and the likes. So over to you. And just let me put this disclaimer again. No stocks that we discuss here are to be taken as advice. They are for educational purposes. So what do you, Anil?
Yeah, so unfortunately, there's no easy recipe for that. Okay, so what I think you need to do is just step back and look at which is the stock which is likely to see a sustained, say, 5-year growth. Okay, and one of the things that right from my investment journey, right, I used to push myself. Okay, is to say, okay, will this deliver far higher growth, okay, as a company first, before you get into numbers of how the stock does, right? Because if the company does well, the stock will automatically do well. So go back and look from maybe a strategic standpoint, okay, and which are the emerging sectors? Is there some trigger? Like there were triggers for us, like specialty chemicals. There were manufacturing. So we sort of looked at them. There may be triggers for growth there. For and if you looked at some of the other charts around credit quality is improved significantly. So some of the concerns that people have with banks which are slightly poor credit quality. So at this point you may find not so good quality may do better. Okay, so the mid cap, the PSUs, the new age. So you have to start maybe looking for some of those themes, and if you get the theme right, I think that's 50% of it. The rest of it is then going deep down, because the second part is about unfortunately now even you mentioned about what are the pockets of opportunity, right? A lot of it now is bottoms up stock picking. Okay, you have to start looking for stocks because it may be within a sector which has done very well, right? But is this stock likely to outperform? So that's, if you push yourself back and look for that answer, I think then you will be able to look at emerging leaders.
Right. That's very, very astute. I think, Shubhankar, that answers your question. A very interesting question from Mr. Archit Maria. In this inflationary environment, do you see end consumers down trading instead of increasing purchases?
No, so over a period of time, sentiment rubs off. Okay, you'll have more money, you'll go and spend it as well. Okay, if you are investing in the markets, especially, okay, you may go and buy a house, and it's just sentiment, right? So overall, you'll feel good. So you'll start going and doing things which you have not done. And a lot of people are telling me, a lot of hospitality is full, and the purchases and all of that, people are already doing it. Okay, so they'll probably go and increase it. Yeah.
Right. And Anil, we have to ask you this: where do you stand on the mid and small cap versus large cap debate? As we have seen over the last few days, last few trading sessions, mid caps might have taken a beating, but small caps, mid and small caps have taken a beating, but large caps are still quite steady.
Yeah. So again, what we do is we look at data, okay, and we look at relative valuations in plotted on a graph, okay. So and there, from that standpoint, in fact, Sankalp, it may be part of the appendix if you want to move forward there. Okay. So there's a chart on mid caps versus large caps, and so if you see that the graph was very interesting for us, and just make number based decisions, right, rather than do I think it will do well, or suddenly it came down, what do I do? Okay, do I go in, do I come out? Okay, so it follows cycles, okay. And even there are periods when large caps did well, and there are periods when mid caps did well, and as an organization we try to also move between them, and we study those ratios carefully. And what we believe is, yes, it had started its journey. In fact, we did not sell our mid cap fund too much earlier, but over the last few years we started going back and suggesting it to clients. Okay, and those have done exceptionally well. So there has been maybe the last 1 odd years which has done very well in terms of mid and small caps. There is a correction right now, but what data is showing us is maybe we are probably halfway through, and we still are expecting that mid caps and small caps will do better.
Right. Thank you for that. I hope that's a very interesting point on the mid and small cap debate. Views on the auto sector, because auto is one pocket of consumption that has not done well, for a very, very long time now. What do you feel about that? Are you finding value there?
Yeah, so I think auto also will make a comeback. Okay, auto ancillary will make a larger comeback, and if you also are able to get, the equation is also changing. You must keep in mind, right? So electric vehicles are going to come out more and more, and participants who are able to leverage that wave, okay, will do much better. So you can search for some of the auto component stocks which are slightly higher on the EV side or components for that. Okay, you also from the auto stocks itself, the ones which probably are better placed on the EV side. Now that may be a little difficult to gauge, okay, but you have to go dig a little deeper and try and identify those stocks.
Right. And the next question is view on IT, because IT, again, specifically, let's stick to midcap IT, because midcap IT has done really well over the last couple of years, so not just in terms of stock price, but in terms of business also. So let's discuss midcap IT.
Yeah, so I think I also believe mid-cap IT will continue to do well a little bit, because I think the nature of projects, etc. Unlike earlier, it was very large projects, and a little bit more on the emerging area side. Now it takes time for the larger companies to sort of evolve. Of course, I think they are working hard and they are also making that evolution. Okay, and some of them are better placed in that, and those are the companies that sort of you go after. But I think mid-cap IT will also continue to sort of do well. Okay, our view, is slowly the US market will start maturing. Okay, maybe the rupee also may play spoil sport. Okay, it may not depreciate like it has been doing so in the past. If the view that India will be the star, okay, you may see some reverse move there. Okay, so one needs to be a little pragmatic and take advantage of the moves.
Right, agree. So again, the next question is in terms of return expectation from the index for the next 3 years. Okay, so let's just club it with a question which is just very long-term debate, and you're a wealth manager yourself. Do you think active manager can outperform the index over the next 3 years through mid and small cap or multi-cap strategies, or the index will still be strong?
Yeah, so it depends, and in pockets one may be able to find that active management, I think, will still do well. I don't think we are yet in a phase, or we are as mature, in terms of a market that you will find it difficult to beat the index. So I think active management will still, I think, do well. Okay, and you can see that even from the mutual funds and from the PMS houses, etc. Even with some crazy market moves, okay, and yeah, I mean, we are seeing it even with our own stocks, our own funds, right? in a very strong index movement here, you'll find an active management has done better. And I think that will sort of continue. The second part of it is it's also important to see, like, it's not just the current period of boom, right? The point is some of the guys who take or deliver far superior returns, okay, also fall much more, okay. And I don't know how many of us have seen the Templeton PMS of the past, okay. It had a period where it did phenomenally well. If the index did 100%, it did 140%, okay. And but when the market fell, right, on cumulative basis, it fell far more. And including the performance uptick, if you looked at past performances, is worse than the index. And the story was Templeton actually ended up taking out its PMS from India. Okay, after that, it was unfortunate because they came back at a time when it was already down, right? And maybe some investors took money out and lost it all. Okay, so that's the point that I'm keeping in mind. That it's also not important that if you go on a micro basis and keep looking at, okay, can I always deliver the better return? I think if you're able to look at managers who also manage this, then hopefully if somebody is able to help you to fall lesser, I think that is also where, because markets will not predict that, right? You'll just find indices fall just like that, right? So, the way indices are constructed, right, market cap weighted, it'll always be at the highest risk in the momentum sectors. Okay, so from that standpoint, I think is where we believe that you look back at any asset manager, right? You look at, if at a time like this, while you're playing with fire and enjoying the ride, okay, just see, is the manager also able to maintain it on a fall? Because it's unlikely that you're able to get out always at the perfect point.
Right. Thank you. That's a very, very effective answer. Okay, the next question that I have is in terms of diversification. What are your thoughts on diversification and asset allocation now? Now that equity has outperformed, and I mean, the word on the street or even participants on this call feel that equities will still outperform over the next 1 year. So, what's your thoughts on diversification and asset allocation now?
Yeah, so unfortunately, there are both sides to it, right? I manage risk, right? So I like to be reasonably diversified. Okay, but at the same time, there are views also that diversification is for fools, right? So who don't understand, and to some extent both are true, right? And so at times like these, while market is moving, it's good to if you concentrate on equities. And interestingly, that's how we work. Okay, but we look at it on risk managed basis. So when markets are low and have fallen or doing poorly, I think the risk is much lower. So I don't mind taking higher level of risk. Okay, so one likes to do a dynamic asset allocation, not like in a slightly more evolved way than maybe just one of those funds which automatically just move it as a percentage. Okay, because those what you lose out the upside, when if you're completely diversified there. Okay, so the point is, one needs to see how we diversify sort of well enough. Okay, and so I'm just saying diversification is important. Okay, but you need to do it a little more effectively. Okay,
right.
And take a higher level of risk when things are bad, but when things look eccentric, okay, slowly you need to go more and more into diversification and then start looking for assets which sort of do better. Okay, so now that is it's not an easy thing. Okay, but if you follow certain indicators, if you follow certain market related aspects, right, then you may be able to take care of it well enough.
Yeah. Right. That's very brilliantly put on asset allocation at the market tops, and it is something we cannot stress enough about how important it can be to most investors. Okay, very few people would.
Just to take that forward, at times we also have looked for complementary assets, right? So
Right.
we use gold effectively. So that is even better than just saying, okay, I'll be debt equity X. Okay, so that, because you know that in case of a larger market fall, in fact, prior to COVID, that's the other thing that we liked on, because it was a contrarian fall on gold. Okay, so you need to look for those. At this time, unfortunately, diversification will not yield you returns. Okay, because in debt will give you pathetic returns, and it likely to continue to deliver low returns. Okay, so how do you manage it? Maybe if you are a mutual fund person, then a dynamic asset allocation fund can be something you can add into your portfolio as well.
Right, right. Brilliantly put. So the last question that we will take is on new age companies IPOs. If you have any thought on global investing, Indian investors investing outside India, buying new startups. Your thoughts on that, because that is something that the market is talking about, and I think by next Samvat a lot of these companies will be listed. So the real question is, should investors buy these companies that are getting new age businesses, new business models that are being listed on the exchange for looking for the next Samvat, or probably even the one after that? Over to you.
Yeah, so again, what makes me uncomfortable is when you see over enthusiasm, right? And it becomes the major theme, and everybody is talking about it, and the number of AIFs which have come out in pre-IPO. Okay, so there's a lot of money which has gone in there. So what it does, it takes out the juice, right? So if I would think at least 50,000 crores has gone into pre-IPO market, right? I mean, it's very large. A single fund, some 4,500 crores, 6,000 crores. A lot of them have happened with evolved investors sort of putting money in, right? So what it does, it takes the juice out. The second part is you have to be, as soon as you see exuberance, you have to be cautious. Okay, so I'm not saying that I also have believed that some of these companies will do well. So you have to start looking for places where you have some margin of safety. Okay, if you're a slightly more evolved client with a larger asset size, I would not even do pre-IPO. Maybe I would look for some of the venture capital opportunities, but I have to be diversified. Okay, now a lot of questions have come to me. Okay, Zomato, did we invest in Zomato? Why should they not, etc. My point to clients, if I did invest in Zomato in my portfolio, I would have got very low allocation, right? And then I'm struggling with a stock with a low allocation in my portfolio. Then I have to anyway go and buy it in the market later. Okay, so typically, just don't go into the craze of the IPO side. And if history has taught us, the first few IPOs go well. Okay, people put in more money, and the last few, all the junk comes, and the fall is absolutely crazy, and you get decimated. Okay, so that's something that you keep in mind, something which is over exuberance. Okay, just be cautious. I still think the theme will play out for some more time. Okay, look for pockets of how you can do that a little more intelligently, and I think that should sort of do that.
Right. Thank you, Anil, so much for this session today. I think we had a very patient audience and very interactive audience. So thank you to the audience for all your questions. I'm leaving my email ID for any questions that we couldn't answer, or any feedback or any comments that you want to send to us. Thank you so much, Anil, for being with us. Thank you to Right Horizons. We will hope to see you soon again. Thank you to the audience. Have a nice evening to all of you. Thank you.
Yeah. Thank you, and have a good day.